Have you ever come across phrases like buying the dip or investing in Tesla while scrolling through social media? If you've ever wondered what these terms mean and what exactly people are buying, you're not alone. Today, we're diving into the intricacies of the stock market, unraveling what stocks are, how they function, and why they excite investors around the globe. To understand stocks, we need to visualize them as tiny pieces of ownership in a company. When you buy a stock, you're purchasing a small fraction of that business. Imagine your favorite company as a large pizza sliced into numerous pieces. Each slice represents a share of the company. If you buy a slice, you own a portion of the pizza, or in this case, the company itself. This concept of ownership is fundamental. Owning stocks means you have a stake in the company's success. If the company grows, your shares can increase in value, allowing you to profit when you sell them later. You might wonder why companies would want to sell pieces of themselves to the public. The primary reason is to raise capital. Running a business requires significant financial resources for various activities, such as building new facilities, developing innovative products, or even expanding into new markets. Instead of borrowing money from banks and incurring debt which would require repayment with interest, companies can opt to sell shares of their business. This method allows them to raise funds without the obligation of repayment. The money generated from selling shares becomes a crucial resource for a company's growth and development. Let's illustrate this with a story about Maya and her dream of opening a unique sneaker store called Fresh Kicks. Maya is passionate about sneakers and wants to create a shop that offers limited edition releases and exclusive collaborations. After carefully calculating her expenses, she realizes she needs $100,000 to launch her business. However, Maya only has $50,000 saved. Instead of taking out a loan, which would burden her with debt, Maya decides to divide her business into 10 equal shares. By investing her $50,000, she keeps 5 shares for herself, with each share valued at $10,000. She then sells the remaining 5 shares to investors who believe in her vision for Fresh Kicks. One of the investors is Jordan, a sneaker enthusiast who sees the potential in Maya's concept. He purchases 1 share for $10,000, meaning he now owns 10% of Fresh Kicks. With the combined investment from Jordan and 4 other investors, Maya successfully raises the $100,000 she needs to open her dream sneaker store. How investors profit from stocks. Fast forward 5 years, and Fresh Kicks is thriving. Maya has expanded her business, opening multiple locations, and the value of her company has skyrocketed to $300,000. Let's revisit Jordan, who invested $10,000 for his share. His 10% ownership is now worth $30,000. If he decides to sell his share, he stands to make a handsome profit of $20,000. However, investing isn't always a guaranteed success. What if Fresh Kicks faces tough competition from online retailers and the business value drops to $80,000? In this scenario, Jordan's share would only be worth $8,000, meaning he incurs a loss of $2,000 on his initial investment. This example illustrates the inherent risks involved in stock investing, showcasing how fortunes can change based on a company's performance. Some companies also distribute profits to shareholders through dividends. Dividends are payments made to stockholders from the company's earnings, providing a way for investors to earn a return on their investment without selling their shares. Receiving dividends can be an attractive feature for those seeking a steady income from their investments, where buying and selling happens. So where do investors go to buy these shares? They turn to stock exchanges. Picture a stock exchange as a bustling marketplace where investors can buy and sell shares of publicly traded companies. The most recognized stock exchanges include the New York Stock Exchange, NYSE, and NASDAQ. In the past, investors had to go to physical trading floors to execute their trades. Today, technology has transformed the landscape. Investors can buy stocks directly from their smartphones through various investing apps.
This accessibility has democratized investing, allowing more people to participate in the stock market than ever before. When a company grows large enough, like if Fresh Kicks expanded into a national chain with hundreds of stores, it might go public by listing on a stock exchange. Going public opens the door for anyone to buy and sell shares of the company, enhancing its visibility and reach in the market. Not all stocks are created equal. Companies typically issue two main types of stocks, common stock and preferred stock. Understanding the differences between these two types is crucial for investors. Common stock is what most people think of when discussing stocks. When you own common stock, you gain voting rights, meaning you can participate in important company decisions, such as electing the board of directors. The more shares you own, the greater your voting power. While common stockholders may receive dividends, these are not guaranteed. If a company experiences financial difficulties, it may choose to suspend dividend payments altogether.
The primary advantage of common stock lies in its potential for growth. If the company performs well over time, the value of your common shares can significantly increase. However, this comes with higher risk. In the event of bankruptcy, common stockholders are last in line to receive any payments after all debts have been settled. Preferred stock offers a different set of benefits. Preferred stockholders do not typically have voting rights, but they enjoy certain advantages over common stockholders. One of the key benefits is the guarantee of dividend payments. Preferred stockholders receive their dividends before common stockholders, and these dividends are often fixed, providing a reliable income stream. In the case of bankruptcy, preferred stockholders have a higher claim on assets than common stockholders, giving them a better chance of recovering their investments. However, this security comes at a cost. Preferred stocks generally have less growth potential compared to common stocks. You may be asking yourself why anyone would choose to invest in stocks when they could keep their money safely tucked away in a bank account. The answer lies in the potential for growth. While traditional savings accounts typically offer an interest rate of 1 to 2% annually, stocks have historically returned around 7 to 10% per year on average over the long term. Of course, investing in stocks carries risks. The stock market can be volatile, with prices fluctuating based on various factors such as economic trends, company performance, and global events. Some investors prefer a long-term approach, hoping that the companies they invest in will grow over the years. Others engage in short-term trading, buying and selling stocks more frequently to capitalize on price changes. It is essential for investors to conduct thorough research and understand the companies they are investing in. Knowledge is power in the stock market, and being informed can help you make better decisions. In conclusion, stocks play a vital role in the world of investing. When you buy a stock, you're not merely acquiring a piece of paper or a digital entry. You're purchasing actual ownership in a real business. If you're considering entering the stock market, begin with companies you understand and believe in. Remember the importance of diversification. Don't put all your eggs in one basket. Spreading your investments across various stocks can help mitigate risk. Thank you for tuning in. If you found this information valuable, please consider liking this video and subscribing for more insights into financial concepts. What financial topic would you like us to explore next? Share your thoughts in the comments below, and let's continue this journey towards financial literacy.